Equity is a term used in finance and accounting to represent the residual interest in the assets of an entity after deducting its liabilities. In other words, equity is the net worth of an entity, which includes its assets and liabilities, and represents the amount of value that is left over for the owners or shareholders. Equity can be classified into two main categories: owner's equity and shareholders' equity. Owner's equity refers to the portion of the assets that are owned by the owners of a sole proprietorship or partnership, while shareholders' equity refers to the portion of the assets that are owned by the shareholders of a corporation. Owner's equity is often calculated by subtracting the total liabilities of the business from its total assets. This represents the net worth of the business and represents the amount of value that is owned by the owner or owners. Owner's equity can be further divided into several categories, including contributed capital, retained earnings, and accumulated other comprehensive income. Contributed capital represents the funds that have been invested by the owners of the business, including any initial contributions made at the time of formation as well as any additional capital injections made over time. Retained earnings, on the other hand, represent the accumulated profits of the business that have not been distributed to the owners in the form of dividends. These earnings can be reinvested in the business or used to pay down debt, among other things. Accumulated other comprehensive income represents any gains or losses that have been recognized in the financial statements but have not yet been included in net income. This can include unrealized gains or losses on investments, currency translation adjustments, and gains or losses from hedging activities. Shareholders' equity, on the other hand, is calculated by subtracting the total liabilities of the corporation from its total assets. This represents the net worth of the corporation and represents the amount of value that is owned by the shareholders. Shareholders' equity can be further divided into several categories, including common stock, preferred stock, and retained earnings. Common stock represents the ownership interests of the shareholders, and is typically the most basic form of equity in a corporation. Preferred stock, on the other hand, represents a special class of stock that typically carries certain rights or privileges, such as a preference for dividends or a preference in the event of liquidation. Retained earnings for a corporation represent the accumulated profits that have not been distributed to shareholders in the form of dividends. These earnings can be used to fund future growth, pay down debt, or repurchase shares, among other things. Equity is an important concept in finance and accounting, as it represents the value that is available to the owners or shareholders of a business after all liabilities have been accounted for. Understanding the different types of equity and how they are calculated is essential for making informed investment decisions and assessing the financial health of a business or corporation.